Hi, I'm Linda Eedes. This is an update on the RECM Global Fund, looking specifically at the third quarter of this year, talking to how the Global Fund performed, some of the contributors to returns, some of the detractors from returns, comparing that, of course, to the global equity markets, and then, of course, discussing how the Global Fund is currently positioned. So if we look at the third quarter of this year, it was a flat quarter. If you look at the MSCI All Countries World Index, which is the index we typically tend to compare the RECM Global Fund's returns to, it actually generated an exactly 0% return. But actually, if you look at the disparity between developed markets and emerging markets, this tells a different story. So developed markets actually didn't do too badly, and that was really because a lot of the central banks, such as the US Fed, have started to cut rates, and of course that stimulates equity markets. On the other hand, trade tensions between the US and China has caused a lot of angst with regards to emerging markets and the potential opportunities there. So emerging markets as a whole were down 4% in US dollar terms, with many emerging market currencies actually coming under pressure relative to the dollar during the quarter. And of course, the South African equity markets were also down about 4% in rand terms during the quarter. So not such a great run for emerging markets, a better quarter for the developed equity markets. And this sort of neatly segues into the Global Fund's returns. The Global Fund was down 2% in US dollar terms during the third quarter. And this is not surprising if you think about the fact that we have not been exposed to the US market. We have less exposure there. We do have some select value opportunities within that marketplace, but they're not the big tech growth investments which have actually been continuing the US rally. The US market, we believe, still is elevated. It represents a significant downside risk from current levels. So we have actually had less exposure to that market than, for instance, the MSCI All Countries World Index would have, which is about 50% US. And we have more exposure to some of the other parts of the global equity market, such as emerging markets, where we see value opportunities, areas like Brazil, Russia, and then, of course, to areas such as the UK, where uncertainty with regards to Brexit has, we believe, created an opportunity for long-term investors to actually buy high-quality businesses at prices well below their fair values. So we also have some exposure to sterling as a currency that has subsequently rebounded quite strongly after quarter end, but certainly during the quarter, sterling was actually weaker, and that would have had a negative impact on the Global Fund's returns. It's important to mention that since the beginning of 2016, which is really when US interest rates started to sort of change direction, before, of course, coming back down again, the fund is actually up 38.2% in US dollars. And that is behind the MSCI, which is up actually over 40% over the same time frame. But remember that this global fund has got no tech exposure. It has none of the exposure to those areas of the market which have pushed the MSCI in a very concentrated part of the market much higher. So our exposure actually varied to many different geographies, not the US, and yet we have almost managed to keep up with the US market. Now, unfortunately, as we know, markets are not made up of just bull markets. They don't just go up neatly in a straight line, which you would be forgiven for not thinking that, given the last decade of US equity market returns. But certainly over the long term, one has to position oneself to protect against downside risk. And we believe that there is significant downside risk in the US market in particular. If you look at what has actually fueled those parts of the market which have been a big feature of that investment success, it's really been record profit margins, the market's being prepared to pay record high prices for those underlying earnings. In other words, valuations are at all-time highs. And then also incredibly low interest rates, which have been extraordinary. So for those current prices to be justified, you need all three of those things to be maintained. So you need profit margins not to revert back to historic norms in any shape or form. You need interest rates not to reverse. You need them to remain low. And you need the market to continue to be prepared to pay very, very high prices for the future growth of these businesses. So if any of those things fall down, you've got significant downside. And I think there's this perception that you need to have this big crash in the markets for value to outperform. And that's really not the case. One of the strong advantages of a value-based portfolio is that it's positioned away from the hype. It's typically invested in areas of the market that are unloved, neglected, ignored. And that is a very strong feature of how value outperforms over time, by holding its ground when markets are under pressure, and then by generating returns just as you go along, as those individual investment ideas unlock. So in terms of actions during the quarter, we actually introduced, interestingly, given that discussion, a US stock, but this is a retailer. Now, you will know, if you follow the US markets, that retailers have been under immense pressure. In contrast to the tech stocks, or even those that have a retail presence, such as Amazon, a lot of the high street stores, those that have a kind of physical presence, have been under huge pressure. Not only because obviously, our consumer patterns are changing, but also because of the Amazon effect and the impact that that might have on these retailers. This does, though, give us an opportunity to buy some very good businesses where the baby's been chucked out with the bathwater, such as Nordstrom. Now, this is a retailer, it's a clothing retailer, and obviously it operates in sort of a higher segment of the market, and they already have a strong online presence. 30% of their revenues actually are online. But the interesting thing is that this negative sentiment around the whole retail sector as a result of Amazon has actually presented an opportunity for us to buy a very good business, which has generated very good returns on capital historically at a really low price compared to that earnings power. So that was an opportunity at allocation to Nordstrom. We also added exposure to a European business called Tact, which is a business-to-business seller of office equipment and the likes. Now, manufacturing activity in Europe has been contracting. That has obviously a spin-off negative impact in terms of sentiment on these kinds of businesses, which are quite correlated to the business cycle. Again, we're able to buy a very good business, which actually has exceptional historical returns on capital at a PE of 10. So really what you want to do is take those negative sentiment and actually sort of sift through the opportunities and find those where you're actually buying good businesses at prices that make sense. So overall, during the quarter, some of the things that actually delivered returns were new additions to the fund. We actually spoke last quarter about Brookfield Asset Management. We spoke about the gold basket, which has been in place. Now, the gold stocks actually performed very well during the quarter, with interest rates in the developed world remaining low. Now, these two investments actually performed well in a completely different set of circumstances to what would cause any of the other investment opportunities in the fund to do well. What we're trying to do is build a very robust portfolio which holds its ground when markets decline, but which generates, as time goes on, absolute returns through value unlocking in various segments of the market, various geographies, different industries, different sectors, through some market pricing inefficiencies such as spin-offs, which tend to be undervalued at the time that they're spun off. All of these basically we've put together to form a portfolio which is very robust and which is not dependent on any one specific macroeconomic outcome. And I think that's very important because, if you build a portfolio which depends on you being right about your macroeconomic outlook, then you have a big problem if you turn out not to be correct or if the timing of that doesn't work out as you expected. What we want is a portfolio actually that is anti-fragile, a portfolio that's actually going to just go along and generate returns over time, protect capital, not expose investors to huge downside risk by having too high expectations, and actually buy businesses, good businesses, at low prices. One of the analogies that I heard recently, which I really liked, is that you really want to buy those businesses where downside is limited, and one way you can think of it is it's hard to get hurt falling out of the basement window. And that is really sort of the backdrop with which we construct the portfolio, stacking the odds in favor of absolute returns while protecting against downside risk.